are the challenges of the economy tomorrow's opportunities? What context do we have right now? New York City is the financial heart of the world. It is the place where the biggest transactions and the most important deals are made. The New York Stock Exchange is a place with a great history. Its origin dates back to 1792 with the famous Bottom Agreement. Years later, it is still the nerve center of investment. Major companies want to go public in the United States, while traders' operations continue to increase. What is the outlook now? What has changed in investment and what is the challenge for the economy and the stock markets today? I've been able to visit the New York Stock Exchange and do some interviews to draw some conclusions. Let's take a look.
Hi guys, I am in the New York Stock Exchange. I'm very excited to be in this place. It's the most important day in my entire career. I'm gonna make 2 interviews inside there. Cassandra Sayer, who is the head of markets, international markets, in New York Stock Exchange, and then I will interview Peter Tuchman, who is a legend in trading. So let's go inside there. We are inside the terminal 4. We are waiting the opening bell. Today is the Crane APO, so this is an exciting day. So we are waiting the opening bell. Exciting moment. This is an amazing moment here. So now we're gonna interview to Cassandra Sayer, which is the head of international markets in New York Stock Exchange.
So, first of all, thank you very much for having me here for this talk. And first question that I want to ask you is, 2023 looks set to be a difficult year. So has the rise in interest rates affect to IPOs?
Yeah, so 2023, has so far been quite volatile, and I think it is important to, just make sure that the market conditions are a little bit more settled for IPO markets to come in. We're quite optimistic about the pipeline. There were some deals that were delayed from 2022 and now, delayed further. But once the market condition improves, which includes interest rates, stability, we do expect more companies to come out from internationally as well as in the US.
Do you think this may change in the coming months? What is your outlook?
Well, we are cautiously optimistic. We do think that there are great companies that are waiting to tap the market once the market conditions improve. So our outlook is positive. We have companies that are waiting in the pipeline from all over the world that are coming into the US to tap the most liquid US market. And we are excited about, using this time to build strong relationship and strong pipeline with companies overseas as well as in the US. My team is focused on international capital markets, so we take non-US companies from private to public. And so we have been spending a lot of time meeting companies in person, traveling around the world to make sure that companies are able to come in and tap the market when they are ready.
Despite recession fears, do you see very good years ahead for new companies to list in the New York Stock Exchange in the long term?
For sure, in the long term, this remains the most unique marketplace where we have the most breadth and depth of investors and companies that are doing great things to change the world. We do think that in the long run, there is a very strong pipeline of companies that are ready to come to the New York Stock Exchange.
What What interest do you see in foreign companies listed in New York Stock Exchange? In Spain, there is a talk of interest in Ferrovial, for example.
Yeah, we see a lot of interest coming from Europe in general, and there have been a lot of headline news, including some where I was speaking to with the FT and the Times. We do see European companies being very interested to come to the U.S. to tap into the deepest liquidity, and to speak to investors here. So it's been quite busy for us and our team, traveling to Europe quite a lot, to make sure that they understand the tools and services that we can provide, and the unique value proposition with the New York Stock Exchange, which really also includes the floor-based trading model that I know you had a pleasure of going down to see the trading floor. We still have traders there to make sure that they're providing human oversight to a really state-of-the-art technology of our trading system. So yeah, I think from a international side, lots going on, and Europe continues to be of a high focus for us.
And just the last one, which is what are the main challenges and opportunities for New York Stock Exchange in 2023?
Well, market condition remains to be, of question, right? We need to make sure that market conditions improve before we can start to see more IPOs come in. So I think right now we are really focusing on the opportunity, which is on early engagement with companies all around the world, and to make sure that they know what New York Stock Exchange value propositions look like, as well as the ability for us to act as advisor to companies to help bring them to the public place when the market conditions improve. Right now, the pipeline is really strong. So once the market conditions is better, we do expect some companies to come in this year and beyond.
So thank you very much for your time.
Yeah, thank you, Hector. Good to see you.
While considers.
Okay.
Well, the CEOs of our company.
Yeah, the CEOs, no? Salesforce, yeah. BlackBerry, FedEx Corporation, and Warren Buffett. This is the big one. The CEO of Berkshire Hathaway, the legend of value investing, Warren Buffett. Yeah, we are here with the Bretton Woods Agreement, because they think this agreement underneath its branches to organize trading and ensure public confidence in the markets. We're going to interview Peter Tuchman. I'm very nervous. Much, Peter, to talk with me. This is a pleasure for me.
Pleasure.
So I want to ask you some questions. First of all, how long have you been trading here in the New York Stock Exchange?
I've been trading here for 137 years. See, I got a reaction out of it. Yeah. We're here on the floor of the New York Stock Exchange in the gallery. I came here in 1985. Okay, so for about 38 years, people often joke. I often will say when I do interviews that I went to high school with Alexander Hamilton, and he's buried across the street in the cemetery, and I'm still trading here. So yes, actually 1985, 38
1985, years. Oh, so long, yeah. What are the difference between trading when you were starting at the New York Stock Exchange and now? How has trading changed?
Look, trading has changed, our lives have changed. Technology is the biggest differential that has happened. Obviously what drew me to this place was the human element, right? In 1985, we had what's called an auction market, open outcry. As people have seen in the movies, people screaming and yelling. There were thousands of people in this room, and the whole nature, everything was done on paper, right? Even though I'm a firm believer that the way we used to transact business is very much like we talk, blockchain, right? Is a big thing now, right? Developing the ledger of how things are traded. And back in the old days, we used to have thousands of people here, and there used to be a support staff. There used to be squads, runners, teletypists, reporters, market makers, clerks, backup clerks. There was an incredible support staff identifying the trades. When I would buy stock from someone else, you had to identify who I represented, what company I represented, how many shares, the price of the stock. So we had a lot of people to basically establish that ledger going back and forth with the stock. I think the biggest difference is the amount of people that were here, the excitement and adrenaline around it still exists, but it's a little different, and obviously the technology. I think technology has changed all of our lives and all industries. obviously with you guys, whether it's media and print media has changed a lot with technology,
Yeah, sure.
as our business has changed too.
How do you remember the early days here? How do you remember that?
So I started working here on May 23rd, 1985. My booth, the company I worked for, was called Cowan and Company, and they are no longer in existence. Well, they do exist in a different way, and we traded underneath the podium. I came in, I was started, so there's no training for this job as a broker, right? You have to come here and you have to start at the bottom and you work your way to the top. So there's no school that you can go to become a broker. When somebody comes down here, their dream, I don't know if I have my badge on me, no I don't, is to get a seat on the stock exchange. That gives you the right to trade stock. So when I started, I came down, I got a summer job as a teletypist. Back then, a teletypist, if brokers were trading stock in the crowd, and then you had a ticket, I bought 100,000 shares of IBM at $123, and I bought it from broker Goldman Sachs, badge 588. The order was executed in the crowd. The piece of paper was taken back to the booth. The clerk would then report it to the trader upstairs, and then that piece of paper had to be given to a teletypist who would input the information, who bought, who sold, the price, the companies that were represented, okay, and the badge number, the person who did the execution, so that they could go back to it and transact money going down the line. So that was my first job as a teletypist. The minute I came down here, I knew I'm a humanist. I love people. You know, for me, I don't even own a computer. I've never owned a computer. And so I don't really like that sort of disengagement. I like engagement with other people. I think it's so much more obviously personal, but more exciting for me. So the minute I came down, the adrenaline, the excitement, the amount of people in this room, I mean, it was chaos. Some people don't like, I thrive on chaos. Some people don't particularly like chaos, but I love the energy, the adrenaline, the excitement in the room. For me, that was my first impression. The minute I walked on the floor, I knew it was the place for me.
And it was more stressful than right now, these years?
You know what, it was a different kind of stress. Yeah, it's a different kind of stress. Look, at the end of the day, I am representing customers of my company. Okay, we are trading money. People are funny about money, right, in a market that's going up and down thousands of points like now. The market then was very volatile and chaotic. Since I've been here, I saw the crash of '87, the bubble of 2000, the financial crisis of 2007, 2008, the crisis around COVID, and just recently the banking crisis. So I've been around trading many crises, many years of volatility. So that's chaotic and that's stressful. Back then it was a different kind of stress. You had a lot of people screaming and yelling. It was all being done by one person to another on paper, and sort of in a way, even though, you know, I think this market right now, even though there are less people involved, is a little more stressful for me because I'm not that technologically savvy. And for me, I rather have that one-on-one personal interaction. I was really good at what I did back then. I was sort of loud and obnoxious, and I loved and thrived on chaos. So while, yes, it was crazy and volatile and chaotic and very stressful back then, over the years, I've gotten, you know, I've been doing this for many, many years, as I said, 137 of them. So I've gotten, you know, good at what I do, and you know, it just different stress, I think, is the best way to answer the question.
Okay. Do you have any advice for young traders with your experience, your whole experience?
So look, I think it's important for your audience to know that there are investors and there are traders. It's a different genre, as it were. Okay, one of the things that I've done with my life is I do trade on the floor with my son. I don't know if you met him. He's in the booth there. He's that very tall guy he maybe wasn't in the booth when you arrived. But anyway, I run a trading academy. So I've taken a lot of my time away from what I do here on the floor, and I put it towards trying to educate, motivate, inspire young people to invest in their future and also to trade the market. So I run an academy teaching people to trade, technical analysis and risk management. And I also go around the world and I do motivational speaking about getting young people to invest in their future. We have a generation now, probably more than ever before, of basically the greatest consumers in the world, right? We have this sort of instant gratification. I see something on Instagram, I have to buy it, I buy it, it's delivered to my house in 4 minutes, right? You know, that kind of a thing. And we've become accustomed to needing stuff, right? We have 1 million pairs of sneakers, 1 million phones, 1 million clothes, 1 million things, right? If we go to our house and we open the closet, there's a lot of stuff. And the minute we buy those things, they go down in value. Okay, so one of the messages that I've developed over the years, it's not my idea, it's just an idea, that I think people should invest in stocks and not stuff. You know, if your iPhone is not broken, your iPhone 13 is not broken, you don't need the iPhone 14. You should maybe go out and buy a couple shares of Apple stock. And this is not a recommendation. Or, you know, you have 12 pairs of sneakers, you may not need it, go out and perhaps buy a share of Nike stock. Or, you know, people will come to me and they say, I don't know anything about the stock market and I don't know what to invest. And I say, you actually know a lot more than you think, right? All the stocks there, I mean, if we look at all the companies going by, look, I can see it right there. Merck is the company that made things to do with COVID. Morgan Stanley is a brokerage firm. Nike is a sneaker company. ServiceNow is an iCloud company. Novo Nordisk, another one that made one of the things to do with COVID. So all the companies that we trade here are things that we consume on a daily basis. And if you ask a young person, young people will often ask me, what stocks should I invest in? And I cannot be their advisor, but I will say, go to school. Whether it's a high school student, a college student, I'll say, go to school and look at what phones people are on, what computers they use, what sneakers they wear, what social media they're on, and then you will know, because young people are the consumer generation. They have their finger on the button. They know what's popular. I may think Facebook is popular, well, when in fact it's Snapchat. Or I may think that Nike is popular when in fact it's Under Armour, right? So young people know because they are the pulse of what's going on out there. So my long answer to a short question is I tell people that they should invest in their future. They should put money to work in the marketplace. They should take companies that they like. If you like Starbucks, you're a loyal customer because you like their coffee, buy some stock. If you like Nike sneakers and you're a loyal customer, buy some stock. So invest in stocks and not stuff, and that's the greatest advice I can give them, because at the end of the day, we waste a lot of money on things. At the end of the day, we end up with a closet full of stuff when we should be investing in our future. For a young person to start putting money to work in the market at the age of 18, 25, at the age of 60, they will have a nice nest egg of money as opposed to a closet full of stuff.
And this young generation of traders get used to bullish stock market. They have to change their mind right now with this moment, because we have another moment in the market right now with the bank crisis and, you know, with the hike interest rates by the Fed.
Okay, so a good question. I appreciate the question. So it's important for us to understand that during COVID, on March 23rd, 2020, suddenly we were in a new state of the world, right? The world was under lockdown, right? In the US, people were being given some stimulus money. You suddenly had Robinhood and Webull, new trading apps. The barriers to entry of young people to get into the stock market were down. Anybody with an iPhone and $100 could trade stock. So we created a new phenomenon of 40 million new young traders came into the market. And anybody who hit a button on March 23rd, 2020, knew a bull market and nothing else than a bull market. So they thought stocks do nothing but go up. And that this is a get-rich-quick scheme. It's very easy. GameStop and all the meme stocks and all that stuff. What's happened is that 8 out of 10 new day traders end up blowing up their trading account because they don't educate themselves about the market. They just think if you buy it and the market goes up, I can hold on to it, it's going to the moon. Right? Exactly. That was the mentality around COVID, was all stocks go to the moon. Well, we've seen in 2022 that stocks don't only go to the moon, they also crash. And we've seen in 2023 a lot of volatility. Right, so I think that it's important for the young retail trader to educate themselves about technical analysis, about risk management. They should understand that you need to take a profit when you can, not when you have to. That if you're trading the market, it's not about how much money you make, it's how much money you keep, right? And so the whole mentality, one of my missions is to educate people about the importance of learning how to navigate this market. If I was going to be wanted to become a pilot, I wouldn't just go to the airport, borrow a set of keys, get on the plane and think I could fly because I wanted to fly, right? I would go out and I would buy the books, I would study, I would go to the airport, I would get a teacher, and I would spend years learning how to become a pilot before I ever get on a plane and fly. Same thing with trading. You can't just throw $100 into Robinhood, no recommendation of Robinhood, and think that I could just, get margin and spend $10,000 and trade the market because I thought it was fun. At the end of the day, you can lose money as easily as you can make money. So at the end of the day, educating yourself about the risk, trading the market, about the fact, the wonderful things that the market gives you, stop orders, risk management, bracket orders. The market gives you a wonderful tools to learn how to navigate successfully. And look, if anybody in your audience wants to learn, I'm available.
Perfect, that's good. I want to ask you about the current situation. How do you see the situation of the markets and the economy with the possibility of recession just around the corner?
So I'm a firm believer that we're not going to see recession around the corner. It's possible, it's not where I want to go. I think that, look, markets love to analyze forward movement based on past performance. In the old days, you could see, I did our interview yesterday, and we found out that since 1954, 17 times, the market's first quarter market performance has been 7% or greater. Since 1954, that's what, 70 years. So over the past 70 years, the market's first quarter performance has been 7% or bigger 17 times. And 17 out of 17, 100% of the time, that has happened. The market closed up double digits for the year. Okay? So I think that, so markets love to use old past performance as a judgment of the future. For me, I think what happened during COVID with just the global interrelationships of our economies globally, around COVID, we never had a pandemic before. We never had countries and the world and the globe shut down where for 2 years nobody got on planes, trains, on automobiles. Nobody went to a casino, got on a cruise ship. Nobody went to the movies. Nobody went to restaurants, right? Our world has changed forever. So, and I think that markets have changed forever, economies have changed forever. So I don't think we can base, look, when they say we're going to be in a recession, they're making that inference due to past performance. In the past, when this happened, we had a recession. Okay, I don't think that we can use in a market, so in the old days, a bull or bear market used to take 5 years, 10 years, 20 years to be in a bull or a bear market. In the last 6 months, we've been in a bull market at noon, and then by the close, we were in a bear market. So I think that we are in a new stage of economic mechanism. So I don't think we can judge the fact that we're in an inflation mode, we have raising interest rates, the labor market is like this. It's a puzzle, it's a formula that can create the recession. So I don't think we can make a judgment over past performance of the economic mechanism to predict a recession. We may have one. I don't know what next year is going to bring. I don't know what the next quarter is going to bring. I don't know what next Monday is going to bring. Anything can happen. A few weeks ago, could we have predicted we'd be in the midst of a banking crisis and 4 of the largest banks were to fail? No. Did we would have ever thought about all the things that have happened over the last 6 months? I think that we are in a world with social media, with the information highway, with the way the banks are, with the way the markets are, with the way the global politics are. Would you have thought that 2 weeks ago the Saudi Arabians would cut oil production by 1.6 million barrels a day? No. 2 weeks ago, would you have thought that our frenemies, I call them, Saudi Arabia, Brazil, Russia, China, would get together, have a party and not invite the United States to the party? I don't think so. Would you have thought that suddenly, 2 weeks ago, that suddenly the US dollar, which has been the currency globally used for all interaction, would suddenly no longer, from one day to the next, be off the charts? So I'm saying all this to say that we're living in a world of change. Change that used to take a month, a year, a generation to happen can happen in 15 minutes. So for me to predict what's going to happen in the future is irresponsible. When people ask me, is the market going to go up or down? The answer is yes. Okay, and that's the best I can give you. That's a great answer. It's a responsible answer.
Yeah, sure. But related with you said before, there are some kind of 5 or 7 leading indicators about recession: inverse yield curve, conference board, and other leading indicators.
Correct.
That are point to a recession. How do you read that indicators? That leading indicators?
So I rate those indicators. So an inverse yield curve. In the past, a prolonged inverse yield curve have often pointed towards a recession. We have not had a prolonged yield curve. A year ago, the yield curve inverted for 10 minutes. And suddenly the media was talking we're having a recession. So I say this to say that we're in a bull market at lunch and a bear market at dinner. We are in an inverted yield curve at 12 o'clock, but at the coffee break at 1 o'clock, it's no longer inverted. So these indicators, we have not proven them to be long-standing indicators yet to prove that a recession is coming. They're very flighting. We're there for a minute, we're there for an hour, we're there for a day. And so in my opinion, these indicators can prognosticate the future when we're in them for a long time. But the media loves to be catastrophist, right? It's the biggest day ever, it's the worst day ever, we've never seen this thing up 6%, they've never had Saudi Arabia this. You know what I'm saying?
Yeah, sure.
And look, I respect that's what their jobs are. But to be a catastrophist in a market where people react to your catastrophe is a little bit irresponsible, because you talk about recession, then people start selling. At the end of the day, that in fact was not a great idea. We have, Michael Burry. Michael Burry is one of the great short sellers of our time. 2 weeks ago, he told everyone, sell everything. We're going in a recession.
And then he
3
said,
days ago,
we are wrong.
I changed my mind.
I changed my mind.
Okay, so this is a perfect example of where my prediction can give people some instinct about what's going to happen. And I never predict. Yes, the indicators are pointing towards a possible recession. Could that change like that? Absolutely. Do we know what's going to happen in the war in Ukraine? No. Do we know what's going to happen with the Saudis, the Russians, and the Chinese sort of attacking us in the financial markets? No. Do we know what's going to happen now that they have cut oil production? Is the price going to go back to 100? Is the U.S. going to release more reserves? Are we going to make a deal with Venezuela? No. Do we know what's going to happen with the dollar? No. Do we know what's going to happen with the recession, the inflation story? No. Do we know whether the Federal Reserve is going to keep raising interest rates? No. So I always call this is a jigsaw puzzle. In the old days, it used to be a 250, 500 piece jigsaw puzzle, our life. Now it's 1,000 piece. It's got so many moving parts. There's so much confusion. There's so much high, low mentality and perception that anything can happen from one day to the next.
So just the last question, which is, what are the main assets that do you think that the traders are going to be positioned right now? What kind of maybe gold, maybe what are the main sectors that do you think are more attractive for investors?
Okay, so it's important for us to note that the market is has a very short memory. Okay, so if you think about it, for a long time we had zero interest rates. A lot of the stocks that benefited from that environment was the tech sector, okay? And we learned that because the minute we started raising interest rates, everybody sold the tech stocks. In 2022, the stocks that lifted us out of the pandemic was the tech, because we still had zero interest rates. The minute we pivoted and the Federal Reserve started to raise interest rates, the tech got sold off hard, 60, 70, 80% down. Right? We know that. That was what 2022 was about.
Yeah.
During COVID, there were a lot of, the market pivoted, right? So suddenly the stocks that made us, so in a normal look, on February 12th, 2020, the market was trading at a record high before the pandemic. February 12th, the market hit a record high in the NASDAQ, in the Dow, in the S&P, in the Russell. The banks had a very robust balance sheet. Everybody was happy, slappy. We were all, consumer was in good shape, the bank was in good shape, everything was great. And then over the next 6 weeks, as the pandemic became a reality, the market sold off, everything sold off. The stocks that took us to that level of health as an economy were all sold, right? The stocks that, like the cruise lines, the airlines, the car companies, all those stocks that were part of our normal day-to-day robust economy, suddenly were no longer viable companies. Nobody got on a cruise ship. Nobody went to the movies. Nobody went to a stadium. Nobody went to a casino. Nobody was building houses. Nobody was buying lumber. So all of those stocks got sold. And what stocks rose during the pandemic? Peloton, Moderna, Zoom, DocuSign, right. Now that we are coming out of that, those were the stocks that were trading with irrational enthusiasm during COVID. Well, now that we're coming out of that, DocuSign went from 500 to 20. Peloton went from 170 to bankruptcy. Moderna went from 350 to there. Netflix went from 800 to 170. You know what I'm saying?
Yeah, sure.
So we are now in a new stage of the coming out of the pandemic, right? We don't look right now. What we're seeing over the last few weeks are the stocks that were the dogs of 2022, AMD, Nvidia, a lot of the stocks that got beaten down by the raising interest rate environment are now starting to lift. Those stocks were down 70, 80%, right? You realize that. We saw Shopify, $1,700 trading at 160. A lot of the stocks that were sold off hard in 2022 are starting to lift. So we're in a new environment. It's a post-pandemic environment, but it's also an environment where the interest rate story is not convincing yet. Are they going to keep raising rates? What is the economy going to look like? What are the stocks? Right now we are seeing, well, I can't predict what people should invest in that are good for the time right now. All I can do is sort of analyze, look at things. Well, apparently people see a lot of safe haven in gold because gold over the last 3 weeks has skyrocketed. Crypto, this is not an endorsement of anything. This is an analysis, right? I'm not an advisor.
Sure.
Okay, disclaimer.
Disclaimer, yeah.
But crypto, okay, crypto got beaten up. They sold us. Crypto came along during the crisis of 07, 08, trying to create, in a financial crisis, create a digital currency. Crypto ran from $200 to 69,000 and back to 17,000. But over the last month or two, crypto has rallied 30-40%. So if people are finding a safe haven in gold, in crypto, and now a lot of these tech stocks that have been beaten up. So right now, I don't know what the future is going to be. It's not clear what the interest rate story is going to be. It's not clear what the energy sector is going to do. So I think we still have a lot of moving parts. I don't know what's going to be the next bright wave of the future, but I think people should keep their eyes on the market day to day. Keep your eyes on gold, keep your eyes on crypto, keep your eyes on tech, and keep your eyes on the market, because anything can, if we've learned anything from the last 3 years, anything can happen. A pandemic, a war, a crypto crash, a crypto rally, Twitter going private and going public, anything can happen. It's a wild and crazy world we live in.
So thank you very much, Peter, for your time. It's a pleasure. It's a
pleasure.
Thank you.
Okay.